Welcome to the Crypto Nation, folks. Why does it feel so miserable to be a bear in crypto? The joke is that it's because bears are always broke, and maybe that sounds like a throwaway punchline, but there's a truth hiding inside it. Lately, the loudest noise in the crypto world isn't bubbles popping or retail panic selling, it's the victory lap of the bears. If you've spent even a minute on X lately, you've seen them. Smug, loud, convinced that the October peak at 126K was the cycle top, that the party's over, and that Bitcoin's slide to 81K is only the first step in an inevitable collapse. And here we are, November 2025, portfolios bruised and down a third from the highs. It's hard not to feel like they're the smart ones. It feels like they've won the argument. But they haven't. Not in any way that matters over time. Being a bear is a losing game, not as an insult, but as a mathematical, psychological, and financial reality. Over the long run, bears never win. They get to enjoy a brief window of feeling vindicated, maybe a year every cycle, before spending the next 3 or 4 years being steamrolled by the upward trajectory of Bitcoin and crypto adoption. The problem is that right now, it feels like we might be in that short window where they finally get to puff their chests out. So the question becomes, is this the big one, or just another trap designed to shake coins out of weak hands before the real move? Zoom out, really zoom out, and the fundamental problem with being a bear becomes obvious. You're fighting gravity. You're betting against the best performing asset class in human history. Numbers don't care what anyone feels. Over the last decade, Bitcoin has returned more than 26,000%. Anyone who stayed bearish through that decade got flattened. And yet, pessimism remains seductive. Optimism sounds like naive. As Morgan Housel says, pessimism sounds like someone trying to help you, while optimism sounds like a sales pitch. When someone predicts Bitcoin will hit 500K, people roll their eyes. When someone in a suit predicts an 80% macro-induced drawdown, retail listens. The pessimist sounds intelligent. The optimist sounds reckless. But historically, the pessimists have lost far more money, repeatedly. Bitcoin has been declared dead over 430 times. Imagine being confidently wrong 430 times and still being celebrated for your realism. Another problem for bears is what I call the one-year rule. True, brutal bear markets, 2014, 2018, 2022, last about a year before bottoming. So bears get roughly 52 weeks of feeling like geniuses every 4 years. If the October 6th high really was the top, we're already 7 weeks into that period. Even in the worst case, the early pain is usually the sharpest. After that, the market settles, and people simply endure. Statistically, bears are running out of time before reverting to their usual position, being wrong while Bitcoin trends upward. And even when they're right in the short term, bears still suffer from asymmetry. Yes, Bitcoin can drop 80% in a bear market. That hurts. But the bull market that follows often delivers multiples of that. The 2022 crash was a 77% drop, but the recovery afterward delivered more than 700%. No short position can reliably compete with that magnitude of upside. The ceiling for bearish gains is always smaller than the floor for bullish ones. That's why it sucks to be a bear. Smaller potential to the downside, shorter winning periods, and long stretches of getting crushed by macro trends, adoption cycles, and innovation. But beyond historical data and patterns, there's something deeper and harder to quantify. This entire downturn doesn't feel like previous tops. Retail is panicking, sentiment is collapsing, and yet the biggest players in the space, those with long-term insight, resources, and access, are accumulating, not selling. I can tell you that MicroStrategy is buying hundreds of millions of dollars worth of Bitcoin at these levels. BlackRock is expanding on-chain infrastructure along with other mega institutions. This doesn't mean anyone should blindly buy. Billionaires can tolerate drawdowns ordinary investors cannot.
But it is strange to see intelligent, well-capitalized actors buying if the ceiling is supposedly in. It's always good to buy at the FUBAR zone. You know what FUBAR means. Fouled up beyond all recognition. Another way of saying beyond the capitulation levels. While MicroStrategy doesn't have a formal stop-loss, Bitcoin dropping below 60K and staying there, say for 6 months, may create the worst scenario floor. And because MicroStrategy alone holds roughly 3% of all Bitcoin, and other treasury companies hold another 3%, a prolonged crash into that zone could become catastrophic for the broader market, including institutions like BlackRock with massive exposure through ETFs. This isn't financial advice, it's simply a question. How hard will these institutions defend the price if it approaches levels that threaten their balance sheets? Even if the bears are right and we decline further, where is the realistic floor? 60K? 50K? Lower than that becomes increasingly improbable given the rising structural support beneath Bitcoin. Meanwhile, as all this unfolds, the biggest immediate threat to retail investors isn't price. It's security. In times of panic, people make mistakes. Scammers know this. They know you're checking prices on public Wi-Fi, clicking links emotionally, accessing wallets from unsafe networks, and they're waiting. I know the cost of being careless. My team lost over 6 figures in a single hack caused by one insecure connection. Bears might be wrong about Bitcoin going to zero, but hackers are never wrong about exploiting weak spots. That's why serious investors treat VPN protection as non-negotiable. Tools that encrypt every transaction, hide IP addresses, and shield you on public networks aren't paranoid. They're essential. Institutional players safeguard billions with advanced infrastructure. Retail investors should at least secure the basics. No one wants to survive the market downturn only to lose everything to a careless mistake. But security isn't the only hidden cost of bearish thinking. There's also the cost of trying to outsmart the market, something I've personally struggled with for years. My biggest mistake in crypto wasn't buying late or selling early. It was believing I could precisely time cycles. I know someone who entered 2024 with a plan. Ride the market up as a bull, flip bearish at the top, profit on the way down, and repeat the cycle with perfect timing. It sounds brilliant. It never worked for her. The market does not move according to our expectations or our spreadsheets. A 12-month bear market might become a 3-month pullback, or stretch into 30 months, or be derailed entirely by an unforeseen event. We don't know. We can't know. The only reliable truth in markets, across Bitcoin's 15-year history and the S&P's 150-year history, is that long-term trends rise and bearish positioning loses money over time. And that is the real tragedy of being a bear. Bulls can be early, overly optimistic, and even a bit naive, but over long periods they tend to be right more often, right for longer durations, and rewarded far more when they're right. Bears, even when correct, win smaller and win rarely. I'm done playing the game of guessing tops and bottoms, flipping from bull to bear and back again as if I can outthink a global market driven by billions of decisions. I'd rather sit, wait, and let time do its work. So yes, it sucks to be a bear. Not because pessimists are bad people or lack intelligence, but because the math, psychology, history, and incentives of crypto all lean in the opposite direction. And in a world where institutions accumulate, adoption deepens, network effects strengthen, and long-term trends remain intact, betting on collapse is the most exhausting and least profitable position anyone can take. Trade smart. Don't be a dumbass. And I'll see you in the next one.